I want to bring in some comments. Yesterday on this program, economist Harry Dent spoke about the Dow, where he sees it going.
I think this is a major bubble unfolding. The next stop is about Dow 6,000 by late 2016, early 2017.
All right, so that is a very clear bearish view. Dow 6,000 by the end of 2017. Our next guest says no way. Wharton School of Finance professor Jeremy Siegel with me now, saying the Dow is on track to go back to 19,000 by the end of this year. We like this range of opinions. Professor Siegel, why such optimism?
Well, first, let me say that, I was on the major media a couple of weeks ago saying, short run, we're going to have a correction. We haven't had a correction for 4 years. This was a long time, and now everyone is panicking. They say, my God, what the world is falling apart. We used to have corrections every 2.5 years. I still think this one has a little longer to go also. But when I was looking, and we were talking about the Dow Industrials, Harry Dent was talking about Dow Industrials is selling at 14 times earnings. The S&P is a little bit higher, around 16, 17, but 14 times this year's earnings, 13 times next year's earnings. Now, the long run average is 15. In a low interest rate world, and I've done a lot of research on this, it's 18 to 19. And that's why I say what I think is that the true market value of the Dow is around 19,000. Now, it doesn't mean it's going to get there tomorrow, and it certainly may not even get there by the end of the year. We only have a little more than in 3 months. We know the market fluctuates. But I think that either by the end of this year or into next year, we could see a big rally in the market.
All right.
Basically, what we had was the oil collapse and the surging dollar. And that's what stalled out earnings. And then with China tanking and earnings stalling, boy, that was the kindling wood for the reaction that we had. Now, what's going to happen to oil? Is it going to stay at 40, 50, go back to 60? I think the dollar is pretty expensive around the world right now. Is the Fed going to tighten? That's another obvious key.
Professor,
and now, of course,
thoughts,
opinion has gone from yes, they will in September to no, they won't. And if the economy goes down, maybe they're not going to do it all this year and into next year.
Okay, so Professor,
and then
hold that
I say
thought.
to myself, you're not going to see the 10-year Treasury much more than 2, maybe 2.5%. And I like stocks yielding 2.5% interest, almost 2.5% interest dividends now, even if they don't have growth.
Okay,
so
hold that
I'm
thought,
long
Professor.
run very bullish on this market, although short run I still see problems with moving forward.
All right, we hear. That is to say, short run, there are issues. Longer term, you made your case very well. I'm going to bring in Troy Gayeski, who is keeping me company for this time. So, Troy, what is your take? We're bringing up the dollar. We're bringing up the Fed.
Yeah.
You actually had Ray Dalio, who runs the world's biggest hedge fund at the moment,
Very
saying,
successful investor, yeah.
forget about the Fed raising rates. The Fed is actually going to go, not only just stay on hold, it's actually going to move towards more quantitative easing. Chances on a 1 to 10 scale of that happening, in your view?
Probably a 3 at this point, because again, unless you think China is truly going to collapse and Europe is going to be sucked into deflation, the trend inflation, PCE in particular, is 1.8% year over year. One of your guests that was doing a lot of fear mongering was talking about there's no consumption income. Consumption income's up 4.5% over the last 12 months. You've had, meager wage labor
and there's
gains.
cheaper gas at the pump. I don't mean to throw that in anecdotally, but it does mean more
all this
spending
doomsday
power.
stuff is nonsense. So we think the probability of another QE is extremely low. But that being said, it highlights the fact that the Fed still has tools. People argue, we're at the zero bound, there's no more tools. If we get into another rough patch, let's say equities are down 20 or 30, the economy, heaven forbid, is facing a contraction, they can still do other things to manipulate markets, which means if you're short right here, after the VIX just hit 53.4 yesterday, you don't have much upside, and you can really get clobbered if we get a big rally.
Yeah, we're back towards Lehman bankruptcy collapse levels with the VIX at that level.
Nibble, 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 buy stuff that's good, avoid stuff that's bad, and you'll come out all right over the next 6 to 12 months.